Good morning, everyone, or good afternoon, depending on where you're located in the country.
Morning.
Welcome back to our session today to talk about financial planning, financial wellness, and ultimately how to prepare for that decumulation phase of retirement. My name is Stuart Skolton. I'm responsible for the financial planning operations of WellCents on the West Coast. My partner, Brian, our counterpart, I should say, is on the East Coast. And we're excited to be back with you today. So, Brian, I think this is a really relevant topic that we're going to talk about as we talk about accumulation, decumulation, what some of the different strategies are. I think there's a lot of content to get through, and we're excited to get everybody engaged and just see where everyone's at. Brian, what are your thoughts on the topic? And kind of as we went and kind of planned about what we wanted to talk about today, I think we had some lively conversations just amongst ourselves too. I think people get a lot of value out of this.
Yeah, well, again, welcome everybody. Thank you for your time. I always harp, time's the most valuable asset. Ultimately, we're looking forward to getting you guys some good information on this topic. Again, just for those of you who haven't been to previous, as Stu was saying, I've been in the business 20 years, board certified. I have a master's degree in financial planning, but I'm also retirement income certified. So probably the bulk of 80% of what I do on a day-to-day with my clients, most of my clients are probably 50 to 50 plus, is the stuff we're going to talk about today. And, retirement decumulation, right? So, a lot of people, obviously, most of the people that are in the call, if not everybody, right? You guys are in our 401ks that we manage for you. So, this year more so than any other year, right, is really bringing to light of being very, very careful about how we draw out for retirement, right? I mean, I tell you what a lot of people will do, especially 401k participants who just kind of leave the money in the plan, or they leave their money, say, in like a Vanguard 2025 target date fund, is inside of that account. Number one, nothing's protected from loss. And number two, in a year like this year, you have bond, intermediate term bond funds are down over 10%. And along with the stock market, thankfully, we've all seen some nice positivity here in the last couple of weeks, but still the stock market's down over 10%. So, being able to decumulate it, if you're drawing from a fund like that, everything you draw from, everything inside of a target date fund like that is negative, and it's very inefficient to be able to pull. So long story short, 401k plans are great savers, they're great accumulators, but they're not very good distributors for many reasons that we're going to talk about today. So I'll turn it back over to Stuart. Maybe we start with one of our poll questions.
Yeah.
To kind of get the juices flowing, and then we'll talk through some different points and things to alleviate some of these issues.
Yeah, so let's load up a poll question here. I think I'm going to have Kelly go ahead, or Brian, if you want to fire up the poll question. I think it's just important to realize this is something that we see just across the meetings that we have with participants is really that, a lot of people don't have that strategy, or they don't have that game plan for how they're going to go from accumulation to decumulation. And that really just goes along with feeling prepared to financially retire. So I love it as we get the poll questions coming in here. We're going to share the results of the poll here, and you'll be able to see kind of where everything's at. But you continue to engage here. Let's see, get a lot of good answers. I think the reality is that just most people maybe don't have that 100% degree of confidence that they're going to have enough money to retire uncomfortably someday. Some of that's normal. There was a study that was done, I want to say it was like 2-3 years ago, even prior to COVID, that found that about 80% of Americans were not confident they'd have enough to retire uncomfortably. And I think that's pretty indicative with what we see just across participants in our retirement plans. And it's hard to have 100% certainty on what life's going to look like a year from now, let alone, 10, 20, 30, maybe 40 years down the road in retirement, or if you're near retirement, what the end of retirement is going to look like. There's just so many unknowns. And so the goal obviously is to help eliminate some of the variables that might make you feel uncomfortable about retirement. So we're looking at the polls here. Brian, does this kind of shake out with what you see with people you're working with too?
Yeah, again, 80% of the people that come into my office are referrals from clients of mine that say, Brian, you're the retirement income specialist. My spouse and I, or just myself, we've saved, and we're excited. We plan to retire this year or next year. And I always cringe a little bit when that happens, because when they were going to retire in a year or two, if they're not in the right place, there's not much I can do for them, right? So a lot of people are saving their 401ks, saving IRAs, buying real estate, starting side businesses, right? Wealth creation during our accumulation years, but they don't have a plan, or they don't have a point B, right? So when a client walks into my office, I always say, hey, that's wonderful. And, congratulations that you're going to retire end of the year. how much do you need in your retirement assets based on everything else that you're doing to retire? And I normally get that glazed look in their face. They just they haven't thought about that. They've known the year they knew 65 was the year 15 years ago, but they never really figured out what the number was, right? And there's always variables that change that. Obviously, inflation's the biggie. Maybe you retire in a more expensive area than you think. Maybe your lifestyle, as far as your expenses, change. So this poll question is pretty indicative of what I see. I was actually kind of surprised we had 12% that said absolutely. I'd love to fact check those folks, but it's pretty atypical for someone to know exactly how much they need. And again, beyond just the lump sum, like I always ask the question, hey, if you won the lottery, Mr. and Mrs. Klein, tomorrow, like what does that number need to be post-tax for you think to be comfortable in retirement? And then the very second question I ask is how much do you need in income a year when you retire to be comfortable? And a lot of times I get the glazed look at that as well. And again, typically when you retire, right, the age band, the income band is not the same at like, let's say you're retired at 65, the income you need at say 66 versus like 76 is different. Usually early in retirement, we're doing a lot more travel. Then you spend typically more time with grandkids if there's a family component. Then we tend to travel less as we get older. So it's not just a stagnant, maybe I need 50, 100 grand a year. But yeah, I'll Stuart, what you see, that's pretty typical. So I really urge folks, just like when I always give I'm a big health guy. So when you talk about like going to the gym and trying to lose weight, there's a million fads, there's a million diets, right? But ultimately, if you don't eat better and or exercise and spend more calories than you take and you're not tracking it, you're not going to get anywhere. Finances and savings is somewhat the same thing. So we got to save, we understand that, we got to save and invest, but we need to be able to have, checkpoints, if you will, to make sure that we're on pace. So we, don't wake up at 65 and know that was our retirement date and we're falling a little short.
Yeah. I mean, I think efficiency is the name of the game, right? And I think everyone, or I shouldn't say everyone, but most people have this consumption curve idea in their mind of, hey, I'm going to retire at 65. I'm going to draw my assets down at an equal, $50,000 a year in Social Security or whatever it is. And that's just going to get them out into a specific age where they, kind of an end of life scenario based on actuarial tables, based on family history, longevity, whatever it is. But the reality is that retirement, and this comes from speaking with clients that are in retirement, it doesn't work that way, right? There's expenses that pop up. There's, home repairs that might happen. There's medical expenses that you might have to pay additionally for. If you do, like Brian said, you want to travel, you want to spend more money on some of those fun activities that maybe you've been waiting your whole career to do, that's going to cost you more money, maybe at the front end of your retirement. So, kind of those variables, and, we'll get into the efficiencies of this in a little bit and some different vehicles that can help smooth this out and maybe make it a little bit easier to distribute. But, we'll get into the tax side of this too. Like that's another big piece of this. As we talk about tax planning, like we did in our session back earlier in the year, how you're efficiently managing your distributions from a tax standpoint is also going to be really, really important. So, I want to talk about 401ks a little bit. I know Brian, myself, like this is something that we've really seen happen a lot. People tend to save really aggressively in 401ks. It's a phenomenal vehicle. And when the 401k was really set up and got off the ground, was running, I think the reality was a lot of people really took advantage of that. Obviously you've got employer matches in some cases. You've got the ability to save quite a lot of money in there up to those high IRS dollar limits. They're really phenomenal vehicles for saving for retirement in the accumulation phase, right? But they're not always the best when it comes to decumulation. And there might be other more efficient vehicles to take into consideration when you get to that point. So, when it comes to accumulation, Brian, like I think we can both agree that 401ks, IRAs, they do a phenomenal job, I think, in a lot of cases of getting people where they need to go if they're disciplined, right?
Yeah. But the biggest thing we want to drive home in the beginning of this seminar is you have to take ownership of trying to have a traction along the way of how much you need to get to and how much you need to save, because we find overwhelmingly that most don't do that. And they don't have some type of a system at 35, 40, 45, 50, 55, et cetera, to see how they are on pace, because they know they want to retire. I think we all can raise our hands that we don't want to work forever, but we don't know how much we need to save and where and how in order to get us there. So the second poll question kind of goes along those lines. let me see if I can actually pull that one up and share it, because it's the same kind of idea as the first question. So I think, did that go through?
On the withdrawal, the efficiently drawdown.
No, the lump sum need poll question, it's giving me an error. Did this come through? There we
Yeah,
go.
I'm gonna launch. Yeah, there you go. It should go through.
You guys see, does that go out to everybody as far as, do you know the
No, we
lump
can
sum
have,
you need?
let's push that out again. So the lump sum you need, here we go.
There we go.
We're getting some results.
I can already see pretty overwhelming, right? Like the middle one is lighting up like Christmas trees, right? So that's pretty common of what we see. So well, Brian, how can you guys help us? Again, this is what we do all day, every day. I have, we have tons of retirement workbooks and questionnaires and Excel spreadsheets and things we send to clients that they do on their own. Obviously, our personal clients that we work with, we kind of help them kind of handhold them through that process. But that's the first thing. Is again, we can't get, we're going to obviously spend a good portion of today's seminar talking about how you draw out that lump sum efficiency, right? The issue very quickly comes from or goes from, I need X amount of retire, I need to get there, to as soon as you retire, that worry of, will I run out of money, right? And being able to distribute that properly is really a big component. But again, if you don't have the right amount to start, running out of money is probably going to be the least of your worries at that point anyway. So we got to fix step one first. And again, make sure you reach out to us, use our email. We can send you all types of workbooks and different things that you guys can go through with you and or your spouse. That's the first step. It's kind of, again, things can change, health stuff can come up. Like I said, you may retire somewhere you didn't plan on, more or less expensive, and we can pivot as necessary, but we need to have some type of a point B in mind to help us get there. But again,
And the only thing I would add is I'm sure in a group this size, maybe we got some pilots or former pilots on the call. We have a large client that we work with. I won't name them, but they're a group of all pilots, like a private jet charter company. And so we actually created this, we call it kind of the pre-retirement, almost like a pre-flight checklist for retirement, like the different things you can do to get your ducks in a row, from, kind of looking at the Medicare side of things, looking at the Social Security side of things, kind of making a checklist almost of all of the boxes that you want to go through prior to retirement. It's kind of a worksheet. If that's something that would be helpful for any of you that are maybe a year or two out, 3 years out from retirement, just throw something in the chat here and we'll definitely get that out to you. But having that plan, like Brian said, most important thing when it comes to preparing. The plan can change, right? The flight path can change a little bit. There's obviously going to be unknowns, but just having the flight path kind of set, then that's really the most important thing. So I want to talk a little bit about, going back to 401ks. I think everyone here is probably contributing to the 401k. That's really the vehicle that is common today. I mean, we obviously know that they're great accumulation vehicles, but what are some of the drawbacks of 401k plans when it comes to decumulation? I think, a couple of them that people don't realize that can really stack up over time are those transaction fees when you're taking distributions out of a 401k plan. To mail you a check from a 401k, a record keeper is going to charge you anywhere from typically $50 to $75 if you've got to overnight it. It adds up, right? It's those costs that add up if you need kind of that consistent income from your 401k plan. So those transaction fees can add up over time. The pro rata distribution problem sometimes is an issue. So like, for example, if you're in a target date fund, like where it's all kind of diversified for you in one investment within the 401k, it's very difficult to dictate where that money's coming from, as opposed to, like, you can't single out single positions to be able to liquidate from on an efficient basis. You're just pulling from the portfolio as a whole. So for example, if the market's down right now and someone's taking out distributions, we probably want to be taking out of more conservative investments rather than be selling at a loss for an investment that might be down, 15, 20% off its peak. So being able to pull distributions in an efficient way is something that's really important. And a lot of times those target date funds, though they're great accumulation vehicles, they have some drawbacks when it comes to taking money out of a 401k retirement plan. Limited investment options, typically they're built, to get you to retirement, but not necessarily to get you through retirement. You might want access to more fixed income bond type investments, different interest rate bond ladders, things like that. And then there's also a high degree of paperwork a lot of times when you manage distributions as well out of a 401k. So those are things that we're talking to our clients about. And, Brian, I don't know if you want to add anything just in terms of the 401k side of it.
Yeah, so again, we're gonna lead again, FYI, how we normally do these for structure is we kind of give you guys some information and lots of good questions I'm seeing coming across the chat here. Kelly, I think one was saying the chat's disabled, but these are a lot of good questions and we're going to get to them. So, we'll definitely start picking off some of these as well. But to piggyback what Stuart was talking about, yeah, 401ks, they just weren't really designed to be great distributors. Stuart ran off a whole bunch of the issues with them as far as when you're taking money out. But the vast majority, the biggest problem is what's called the pro rata problem. If you ever just go on the good old Google machine and Google pro rata problem. So let's say I got $1 million in my 401k and I want to take out 50 grand this year, and it's this year, mind you, where stocks and bonds are down. So pretty much everything's negative in your plan unless you have anything in the cash position. But if you want 50 grand, let's say you have 10 funds in there and what you got cash, maybe 2 bond funds and the rest are stock funds, the 401k, 95% of plans will pull from every single fund to give you that 50 grand. You can't say, oh, hold on, bond funds are down, stocks are down. I know it's just a value on paper until I sell it. So I want 50 grand from my cash. There's some plans that do that, but the vast majority do not. So that's where we get our clients into efficient IRAs and different things. The other thing, well, again, we have certain kind of IRA programs where when the client needs the money, it will look at whatever the highest appreciating asset is to pull that money. So if it's $1 million, I mean, thankfully, actually, small caps are now positive for the year. But let's say it was after the first quarter when every bond fund and every stock fund was down, the system will automatically go pull that, say, 50 grand from cash. So you're not locking in that loss. And if you're doing that, if you were doing it inefficiently like that before, that could easily cut off 5, 7, 10 years of income dollars on the back end of retirement, which obviously you don't want. So those are the kind of things that we build for clients to figure out, hey, how much do we need? Let's get that done first, right? Like our job is not like whenever you buy into a 401k or you buy into an IRA, you're buying product, right? You're buying mutual fund products. With us, again, same thing. We're at NFP, we don't make products, so we can shop the banks, we can shop the financial institutions, we shop the insurance companies. So, but the main thing before we figure out what kind of product we need is where do you need to get to? Like how much do we need and how much income do we need to get grabbed from the account? And the IRAs allow us to do that a lot more efficiently than a 401k does. And the last thing I would say, and Stuart can probably agree with me, is as interest rates, we've all seen them skyrocket here in the last, really 3 months. Mortgage rates have doubled. So you're seeing home purchases kind of fall off a little bit. Mortgage and realtors are having a tougher time. But the fixed rates on a lot of 401ks aren't really shooting up like gangbusters, like the banks were, right? Like my bank account was probably paying 1% 3 months ago. Now it's paying 2%. So some plans that their stable values are starting to jump up. But hell, I bought a CD for a client last week and it was like 3.2% for 1 year, right? Like there's products out there with rates jumping up as quick as they can, where clients are still sitting their money in cash in their plan. There's often some better things outside versus just the one option you have in your plan. Stuart, I don't know if you want to hit on that, but I see that quite a bit. It's just trying to maximize what I call your tax equivalents and your cash type dollars.
Yeah, the efficiency side of it, I think is huge. I wouldn't add anything. I think just really kind of understanding that those different buckets that you pull out of in retirement are really important. And so, going back to the whole conversation around target date funds, I know there's a lot of people that are in target date funds. We love target date funds, by the way. I even use a target date fund in my own 401k, right? Because they're set up, they're easy to run with. I know that, being in the middle stages of my career, they're aggressive, which is what I want right now. And I know they're going to get more conservative as I get closer to retirement. The challenge is, again, when you get to that decumulation phase, not being able to pull out of various positions within that managed portfolio is where it gets challenging. So I think that's where a lot of conversations that I have tend to fall. Once we kind of establish that, hey, we need distributions now, where are we pulling that money out of? And does it make sense to roll over to an IRA or something that gives you more flexibility from an investment side? That's really important. I'm seeing some good questions come in. I mean, do we want to take some of these live here? What are you seeing?
That's
Brian?
what I was going to say. Yeah, let me let's again. We want this to be valuable for you guys, so we just wanted to kind of go over 15, 20 minutes of some ideas, and we'll talk more in detail on those later. But we certainly want to get to some of your questions. I saw one question on here: where is it best to pull the IRS required distribution? I assume it's this person's, talking about if you're 72 or older, you need to pull distributions. And again, most of my clients that are 72 or older, And this is another shortcoming, again, where 401ks don't do as great from a distribution phase, is most plans, again, think of your 401k as a rental property, right? Right now, you have tenants in there and they're paying you rental income, but they're just getting churned right back in and reinvesting into the fund. Most plans do not have the ability to say, hey, hold on, stop. I'm in my 60s. I want to start collecting that rental income and pay that to protected cash, because I need some more safety net money in case when I retire, the market's down. So in an IRA, that's where we can pull those levers. So to answer this person's question, most of my folks in IRAs who have required minimum distributions, we've been collecting their rental property money, if you will, from their investment accounts. So by the end of the year, assuming we don't have a huge run back and we don't just, go way back in the green, which is unlikely but possible, we're going to be pulling that IRS required minimum distribution from that protected cash and that income that we've been collecting. So what's not efficient to pull from, obviously, is going and just pulling from, say, your tech fund or something, or your S&P 500 fund, where we're still down pretty much double digits at this point.
Yeah, I know that makes a lot of sense. Let's talk a little bit about efficiencies. I see some questions about the insurance products, which we're going to get to in a second. So we'll answer that live. But when you get into kind of the efficiencies behind it, there's three different buckets that you really can pull from when we think of investment accounts. We've got our pre-tax accounts, right? Our traditional 401ks, our IRAs. We've got our after-tax accounts, our Roth accounts. That would be the kind of the common nomenclature for that. And then we've got our brokerage accounts. So those after-tax investments, maybe we're saving through a personal account. We've got to think about capital gains tax, depending on how long we've held those positions. Maybe there's some tax loss harvesting that's coming into play, if we're selling some of those investments to create income at a loss. So those three different types of buckets, really it's going to vary in terms of how we manage the distributions. Obviously, pre-tax, anything you're taking out of a pre-tax account, you got to think of income for the year. That's all getting reported to the IRS on your 1099-R form. You've got your Roth accounts, which it's great. You've already paid the taxes on those. And so you're not reporting any of that. And then the capital gains side is happening with the brokerage accounts. How should people really look at kind of pulling money out of these different types of accounts? I think it's obviously going to vary based on what needs are. I try to really smooth this out a little bit. With the taxable accounts, you want to smooth it out as much as you can in retirement. But maybe if there's a big expense that pops up, pull it out of something where there's going to be less of a tax liability, so it's not bumping you into another tax bracket. I think that's kind of the short answer that I would give a lot of people. But Brian, maybe you've got something to add.
Yeah, well, so on that point, again, we've talked a good amount about how 401ks are great growers, but in distribution they have a lot of shortcomings versus using more efficient type withdrawing strategies in the IRA world. But another issue, we've all heard of asset allocation, right? When you guys are in your 401ks, you got some large cap growth and small cap and international and bonds, right? You're nicely broadly diversified. But to Stuart's point on the different buckets, from your Roth accounts to your brokerage accounts to your pre-tax accounts, asset location, not asset allocation, asset location, I see people really falling short on. Well, Brian, what's asset location? So let's take a 401k, right? And let's say I have $1 million in a 401k and 100,000 of it's in the Roth 401k. So I've been giving some Roth dollars. And again, not in the vast majority of 401ks, I can't disseminate that the Roth money is invested differently than the pre-tax, right? I don't have that ability to do that. And typically, as a retirement income certified person, you typically don't go to the Roth money till later, right? Because that's money that there's no RMDs at 72. It's tax-free growth. It's tax-free legacy to children or heirs. So it's a very typical asset that you're planning to use in your later years. Maybe it's 80s, 90s, if not a legacy asset. And what I see a lot of times is, again, when they're in the plan, there may be in like a 60-40 portfolio, and the Roth is the same way. So it's actually way under aggressive from where it should be. And then I'll look at someone, say 10, the same reverse problem. Typically, you want to go to the taxable accounts first in an efficient manner. That's a whole nother conversation. But typically you want the brokerage accounts more conservative. And on the flip side, the Roth IRA, the Roth dollars, much more aggressive. And I see that flip-flopped all the time. Sometimes a new client will come on and their Roth money is all sitting in like short-term treasury bonds, and their brokerage account has all growth stocks in it, right? And they're 3 years from retirement, and they are planning to pull from both at some point. That's very inefficient from getting the most wealth out of those accounts. Like I said, when Stuart's no different. When I do, like I just finished up a retirement income plan for a client yesterday. The PDF I sent her, this client, this is very confusing to a lot of people, but I literally laid out the whole plan in a PDF document that's probably 3 paragraphs, right? So that's how much it's down on paper in words about how we're structuring the various accounts and why they're structured that way. So again, I'll kick it back over to Stuart, but the asset location is a big issue I see. So typically, let's just say you're 65 and you do plan to draw from your brokerage, pre-tax, and Roth, and you have all 3 buckets. Again, Roth typically is the most aggressive, the brokerage is typically the least aggressive, and the pre-tax typically falls somewhere in the middle. And that's where you got to be careful that you're holding the right kinds of things there.
Yeah, I mean, kind of going along more of the asset allocation vein of what you were talking about, Brian. I mean, I think that, there's articles that have been written like prior to COVID that, the 60-40 portfolio is dead. Like when interest rates were really low and the stock market's doing great, people were having to really take on more risk to keep up with just the cost of living, right? In terms of, you weren't getting much return in a fixed income or in a bond fund. Rates are at 1%, 2%, 3% maybe, right, on a good day. So a lot of clients we were seeing coming to us because they were a lot more aggressive than maybe they were comfortable with. So when COVID happened, and then obviously a lot of this inflation volatility has happened in the last couple of years, those accounts obviously are affected very drastically because there maybe wasn't as much fixed income as somebody 10 or 15 years ago could have taken in retirement. And so I think that's starting to come back now. I think this is a good thing long-term for savers, right? That interest rates are going up somewhat. And as things start to normalize here, it's going to give more of that interest, those dividends, kind of being able to set some of that to cash. That's really going to help people in retirement without taking on quite as much risk. I want to get into kind of the insured accounts side of the conversation, Brian. I know this is something that we talk to people about quite a bit, but people know that they're not going to take on as much risk in retirement in most cases. Therefore, they're not going to be able to get the same types of returns they were getting in their 30s, 40s, and maybe their 50s, right? I mean, what are some of the insured accounts? Like, how should somebody think about an insured account? How should somebody think about an annuity? I think sometimes that has a negative connotation. Like people hear the word annuity and it's just like, annuity bad. I don't want that. They heard a story from someone who, maybe was sold an annuity and it wasn't a suitable vehicle for them. But I mean, how should people think about these vehicles? Because I do think there's value there for certain types of investors, certain types of risk profiles. What are your thoughts?
Yeah, so this was I think that was one of the group questions we had is, should I buy an annuity? Again, first off, all an annuity is it's an investment with an insurance for something. So whether that be, investing in something where there's no negative market volatility, so you're protected against market downturns, whether that be you're insured to get, say, 3% over 3 years in a straight fixed annuity to, I have a 401k and I have $1 million and I get if I'm withdrawing out of my 401k and my account goes to zero, that's it, right? I get no more money. I have no insurance that says it's going to pay me as long as I'm around, like Social Security. Hopefully, Social Security is a whole other thing, right? But again, basically with your, those I call those, lifetime income annuities, right? Where you're basically paying a monster global insurance company to guarantee you income, for the rest of your life. So that's typically what I had a client that I started talking to yesterday, or a prospect rather, talking to that was referred from a client of mine. And that was, again, we're just having questions and conversation. And I asked him, I said, look, you're getting X amount from Social Security when you plan to retire in a year. Like how much of guaranteed income do you want a year? You have X from Social Security. Like how much do you want to know that you can't outlive? Is that a concern for you? Some clients will say no, some will say yes. If that is something that he wants, then that's when we look at like the lifetime income annuity marketplace. And I can tell you, we've probably written the more annuities in the last 3 months than we probably have in the combined 3 years, because annuities are really interest rate based. So again, just like structured notes are what banks issue. They're kind of like the annuity of the bank world. But these products, fixed annuities, fixed indexed annuities, variable annuities, whether they have a lifetime income rider or not, they're becoming more advantageous by far than they were 3 to 6 months ago because interest rates have really jumped up. And again, that's where you lean on someone good like a Stuart or I, where NFP makes no annuities, we make no mutual funds, we make no bank products, right? We just shop them all. So I can tell you there's a couple good ones that are out there right now as far as like the ones that provide lifetime income. But the really only ones I put clients in, there's only really about 2 or 3 of these, is where they give you the opportunity for rising income throughout retirement. I'm not a huge fan of the pension annuity, like Social Security, right? Social Security is the biggest annuity there is, right? Because you have lifetime income, and then hopefully every year, every other year, you get what's called a cost of living adjustment, right? To help keep up with inflation. Most annuities where you take, say, $500,000 of your million, they'll pay you 5% for life. They're only going to pay you 5% for life on that $500,000 for a 30-year retirement. Well, what good is that when you have inflation where it is? So you need a good independent person to help you kind of sift through, one, what's your situation, what's a good product to fit, or products, and then talk through them with you. But those are really where we're using them. We're using a few rising income guaranteed for life annuities these days, and then with interest rates rising and people being stuck in accounts that are making 1-2%, there's some good fixed index products that are fixed and guaranteed, like somewhere between 3 and 4%, depending on the time horizon of how long you have to hold it. But yeah, we're using them more than we used to, again, because they weren't advantageous for clients years back, but now they've certainly gotten there with interest rates rising.
Well, I think it's also helpful to understand that typically, the person who's benefiting from an annuity might be the person who's not comfortable taking on enough risk to even keep up with inflation, right? If they were in an IRA or they were in a 401k where they were more heavily invested in equity, right, in stocks, they're trying to really hedge against some of that volatility. Typically, an annuity isn't going to be an easy conversation with somebody who's comfortable with a lot of risk, right? Because a lot of times, if you're very comfortable with a high degree of risk, a high degree of growth, and you're used to seeing that volatility in your account, then perhaps the expenses of the annuity and that insurance component of it aren't going to make as much sense. The annuity is really great for people that maybe don't want to take on as much risk, and they would like to see that consistent rate of return to know that their money's keeping up with inflation without taking on a bunch of the market volatility that they might have in a more personal account. So kind of understanding that component to it. I think the argument that I hear about annuities is really around fees and costs. I mean, of course, nothing's free, right? You're always going to pay for those guarantees that an insurance company is going to give you when they're giving you a guaranteed rate of return. But I think the way I kind of look at it is, if you're not going to have that guaranteed rate of return because your account is too conservative to begin with, then it makes sense to pay for an annuity when it's really going to offset that, if you're not going to be able to take that risk on otherwise. So that's really how I try to position it with clients. I mean, Brian, you might have a more an eloquent answer of something that you've said, or a different analogy maybe in terms of how you explain this to people.
But look, not every certified financial planner is the same, right? Like if someone sat in front of me and said, Brian, I want an annuity that's going to give me lifetime income, I'm not really going to ever recommend one that just gives a flat income and it can't give more than that. It doesn't make sense for me in the way I think about inflation and where it's going. It kind of depends on the situation of what you're in. I mean, I certainly can tell you with everything that's going on. I mean, the biggest concern that most people have right now is inflation, right? Like what's inflation going to do? How do I manage that? Again, Stuart mentioned like, well, I don't like fees, right? First of all, no one likes fees. I love having the fee conversation with clients. The best example I give is the banks, right? Like, well, Brian, I got 50 grand in the bank and I don't pay any fees. I'm like, well, you sure do. You just don't feel it. Right, the bank keeps about 3% of your money, and then they loan the rest out to credit cards and mortgages and student loans. So really, they're probably making 7 to 10% off of you, and they're only paying you 1%. So you could call that an interest spread fee of 6%. Something like, well, annuity has fees. Well, if you look back in your 401k of what you paid the fund managers and the expense ratios and all those things over time, you paid fees for that, right? And if you add that up, that's not always a small number over 30 years. And again, but it's what you're paying a fee for, right? Like you're paying an expense ratio on anyone that's invested in a mutual fund. You're paying a fee for them to manage the money, but if the market goes down like it is this year and your mutual funds are down, that fee doesn't protect you, which isn't a big deal if you're 30, 40, 50 years old. But once you get to the point where you're 10, 5, 3 years from using the money, some folks, to Stuart's point, are more conservative. And, the Great Depression happened, terrorism happens, market bubbles, housing bubbles, these things happen. Some people like to insure that risk away and just like we insure everything else, right? Our cars, our homes, they like to insure that away. And that's where the annuity and the structured note from the bank conversation tends to come in. But ultimately, at the end of the day, it's you have to develop a good overall retirement income plan. Sometimes annuities are a portion of that. Sometimes they're not. I would tell you as a blanket statement, annuities typically aren't for people that are under 50. Like I mean, if someone's trying to get you one that you're, 35, 40, there's a few places where it would make sense, but not really. Certainly a lifetime income, annuity. Those are things where, we don't use those for clients really until they're 5, at most 10 years away. You can still have the time to deal with the ups and downs of the market and get more wealth creation. So fees are always relative, right? I always tell clients, like, it's what are you getting for the fees that you're paying, right? Like, so, and that's what I always come back to. But ultimately, you got to find the right products that you're buying, the right CDs, the right checking savings accounts. Like, I spend a lot of time with my clients on cash management. So a couple of freebies for those in the group. I mean, I know I shoot a lot of people to SoFi Bank they're housed over where Stewart is on the West Coast, federally chartered, but they're paying 2% right now on their checking savings. I often have these meetings and I say, hey, Mr. Client, what's your checking savings paying you? And they don't know. I'm like, you got to pay better attention, right? You're putting your hard-earned money into these places, in the banks. We already talked about, they're making a good amount of money off of you, even though they're not paying you like an annual fee that you see on your statement. It's good to know exactly, where your money is and what it's doing. So if you're not getting at least 2% on a checking account right now, and you got sizable dollars in checking savings, that's something that you want to make sure you review right now with rates jumping. And then I always bring this up, Stuart always laughs, is making sure you get those I bonds. Those I bonds are still paying 9.6%. You got to go to Treasury Direct to buy them. But now you can even buy Treasury notes about 3% now. So, again, treasurydirect.com, you can't get them through a broker. So a lot of brokers won't even bring it up to you. But those are kind of freebies that you can grab since interest rates rose and inflation's high to help, mitigate some of your cash management.
Limited quantities, of course, right? I think the T-bills is 10,000 a year per Social Security number. And then the notes with the I bonds, and then the notes are a bit more. But the reality is, to Brian's point, you don't want to have large lump sums of cash just sitting in a bank depreciating right now due to inflation. You're losing purchasing power. I think there's a good question that came in, and we'll answer it live. In terms of finding good resources, like from an independent advisory standpoint, like who should somebody work with? And obviously this is a little bit of a shameless plug for Brian and I think being on the independent side of the table is helpful. We're not married to a particular product. WellCents doesn't have an insurance product or an IRA product. We don't have anything proprietary in that sense. So we really try to go look at the whole universe of what's available for our clients. But even if you're not working with us, I think working with an independent advisor versus just a broker who's selling a particular product for an insurance company or a fund company is always going to be a better way to go. There's a lot of similarities, obviously, between independent advisors. So, you can find that good independent advice really as long as they're agnostic. They're not married to one particular, they're not an agent for one particular company, I think is probably what I would encourage people to think about. Brian, what are some of their conversations that you have there?
I always tell clients, products are sold, plans cannot be sold, right? So ultimately, if we're talking investment management, I need to put you in. Ultimately, we need to, the client and I have to decide on product, right? Whether it's mutual funds, ETFs, separately managed accounts, real estate investment trusts, whatever, right? Like CDs, bank products, insurance products. We have to figure that out. But that is so secondary to the plan, right? Like if you don't have a plan, those products mean nothing. They have to be. They're like puzzle pieces. They have to be put in the right place. And that's why so many of them exist. Just so again, there's not every square peg doesn't fit in a round hole, so to speak, right? So you always want to make sure that the plan is first. If you're, to Stuart's point, we're biased, right? Because we're independent fiduciary planners. We don't make any in-house product. We don't get. I always tell clients we don't get bonuses. No one sends us on trips to the islands because we made certain minimums. Like none of that. Right. Some clients are like the fiduciaries. I'm like, didn't you just, like a good buddy of mine, I won't name the firm. He's like, oh, I hit my, blah, blah, blah. And they're sending me to like my wife and I to the islands. I'm like, that's a little like, I don't like that. Like, we don't get anything like that. But again, you don't have to always work with us. Obviously it's our little plug, but ask those questions, right? Are you independent? Are you a fiduciary? How are you compensated? And then again, do you get bonuses and trips and, you know, anything like that? I mean, those should all obviously be no's, because there's obviously conflict of interest there. But yeah, I think the next step, I was just want to I'm sifting through some of the questions that came in, because you guys had some really good questions. I was in Stuart, unless you're good with it, I think maybe we spend the last bit of time here just really trying to answer some of these questions.
I like the one here about how to really make your 401k more fluid. Do you have to move it to another account? I think that kind of goes back to, the IRA conversation. If you're looking for more flexibility, I think it does make sense from a transaction fee standpoint to not have it in the 401k in a lot of cases. If you are looking for that fluidity, not looking necessarily at one specific product, as Brian was talking about, but having a plan, right, is first and foremost, having that roadmap for where you're going, and then putting the pieces together about where that's going to come from, where that accumulated money is going to be distributed into. What are some other good ones here?
Remember, just to that point, remember in 401ks, again, they're great. We manage a lot of them. We do a good job with that, but it's not so much NFP. It's also ERISA and the Department of Labor about what can go in a 401k plan and kind of what they want to see from the fiduciary advisor on our side. So like, again, it's pretty typical in a 401k that you have typically 1 or 2 intermediate term bond funds. Those are down over 10% this year for the most part. But you move them to an IRA, I can get short term, I can get long, I can get international bonds, I can get commodities, I can get real estate, I can get sectors. I can do a lot. I can get a lot more sectors available to me, which really helps the distribution phase. Like I can tell you one thing that's done pretty good this year, as you can imagine with inflation, is commodity funds. They certainly don't historically beat the S&P 500, especially over the 5-10 years. But a lot of my clients this year, if we weren't taking from cash, we're taking from some of those commodity funds that are up, because they're in the green, because they are good hedges for things like this. So sometimes people ask me, Brian, why do I have commodity funds? Last year the S&P did 27, and my commodity funds did like 3. Why am I holding this stuff? For this reason, right? Because you're in the retirement phase. You're not. If you were 25, you wouldn't have the commodity fund. You'd have probably all stocks. So it depends on the person. I think one person, it was a good question. It was like, should I put my 401k and put it into gold? How do you feel about that?
Yeah, I saw that one.
Yeah,
I saw that one.
Gold IRA. I'd say the same thing that someone said about, like, putting all my money. I mean, you got to be very careful, right? Like, human beings, we're very cerebral, and all these companies that sell products, they understand behavioral finance and biases, right? So crypto is the best recent example, right? I mean, Tom Brady jumped on the bandwagon. It was, Matt Damon, right? They got all the celebrities and crypto for the last 3-4 years. And, I'm sure Stuart and I fielded probably, 50 calls a year in the last 3 years on crypto. Gold, same kind of thing.
Brian, do you do crypto? Do you hold any crypto personally?
Me?
Yet? Yeah.
I don't. I buy the shovels, not the.
Okay.
I buy the pieces to make the shovel, if you will. So
Yeah. You buy
what I mean for those on the call, the metaphor is like the gold rush, right? Where a lot of people went and bought shovels, and they went into the mines, and some got rich and some didn't, right? But I'll tell you who got rich every time is the people that made the shovels, right? So like crypto can't exist by itself. It has to have the blockchain technology. There have to be Bitcoin farms, PayPal, MicroStrategy. There have to be companies that have assets behind them. So I don't buy any cryptocurrency. I'm not totally against it. It's certainly a very speculative asset class. I buy the pieces that go into the shuffle that are required, the companies that have assets that are required for crypto to exist. And they go up generally around the same speculative nature as crypto does. But back to the gold question, it's not just gold. I always remind clients, like, I tell you what hits me and my wife a lot is when we go to dinner and the food prices and the grocery store, like corn, wheat, like these are all assets these are all commodity assets that go into food inflation. So, so would I move all your 401k to a gold IRA? The quick answer is no. But again, certainly commodities have their place in rising inflation interest rate markets. But again, it's not just gold. There's gold, silver, copper, corn, wheat, oil, right? Like there's a whole slew of commodities people forget about. It's not just gold. So I would spurn you to make sure that you're looking at all those areas, not just one aspect of the commodities.
Yeah, I mean, I think it's an interesting conversation. I mean, I don't hold anything in crypto yet. It's certainly something I'm considering. It is a new space. I think it's more regulation comes into play. There's kind of this law of diminishing returns, right? When it comes to regulation, that some regulation is good, and that can really give a lot of validity to something like crypto, that whole space. If it gets over-regulated, then that could certainly change, and maybe it's less attractive. So it's interesting to see. It's really a developing space. I noticed a question come in about annuities and long-term care. And I think this is a really interesting topic because we're having a lot more conversations with people that are dealing with maybe they're dealing with aging parents, right? And they're seeing this long-term care component, how much goes into it. My wife's side of the family, we've seen this firsthand, really, with some extended family, that just the strain that this is putting on her side, dealing with aging relatives and people stepping up. Long-term care is something that I think, it goes hand in hand kind of with this insurance side of things. It's worth having, but again, you want to make sure that you're doing the due diligence on the product side of it, making sure it fits into a more comprehensive plan. But we're certainly not against long-term care. I think it makes a lot of sense when you look at the cost of which this long-term care is really rising. It's rising in excess of inflation. I think it's like what the average cost is 5 to 6% a year that long-term care costs are going up, is what I saw.
Yeah, it's pretty crazy. I mean, I can tell you, I'm an accredited estate planner as well. So I work with a lot of attorneys. Stuart does the same on the estate planning side. And long-term care is it's always getting more expensive. But these days, depending on if it makes sense for the client, we'll shop the long-term care products. But a lot of times we're doing more asset protection trusts and different more legal planning to help mitigate those eventual 2/3 of us will eventually need long-term care where Medicare only covers 100 days of that coverage. And, I got some clients in dementia wards, right? They're paying 15 grand a month. Like some of these places can get crazy if, who knows any of our futures, right, with medically. So there's lots of ways to skin that cat. But yeah, certainly, healthcare issues and retirement is one of those risks that we wait and see, but we try to plan accordingly. I saw some other questions like how safe are pensions? We manage a lot of pensions in NFP. I manage a couple personally, and we've had to close a lot of them as interest rates dropped for so long. As interest rates drop, the companies really got to overfund them. So a lot of them have been offshore to monster insurance companies. So I would say a pension's as safe as you can get. They're always insured by global insurance companies that are too big to fail. So I think again, pension type annuity products. I mean, you're always pretty safe from that perspective. Let's see
let's take one or two more questions that might pertain here. I think that'd be helpful, and then we'll kind of wrap up. I think this is just such a relevant topic with people thinking about retiring and kind of where they're at. Everyone wants to know really where they stack up. Could we get another poll question or two before we wrap up? I think there's a couple really good polls here.
Yeah, throw another one of those. Throw that last one in there.
Yeah.
Because we kind of talked about this, but let's see what the answers are curiously after our talk. I imagine we probably talked people into the bottom two. Well, there we go. So
yeah,
that's surprising. So this question is actually kind of misworded. Do you plan to efficiently? I'm like, it meant to say, do you have a plan to efficiently draw out? Like, what accounts, when, how much, right? Do we have adequate buckets if the market's down to pull from? So this is a little misleading. I think we missed a word here. Do you have a plan to efficiently draw out of your retirement accounts? Again, where people are falling short, and you see it this year, is I got $1 million. I Googled I can draw 5%. I got a 90% chance of not running out of money. I'm in a 2025 target date fund. Oops, right? That blows up in a year like this. Like that won't be sustainable if you're drawing out at all these losses, unless we have a really good market comeback, most likely. But that's going to put you in harm's way.
Let's share the results with people here. So if we can do that, let's take a look and let everybody see kind of where this is at. Yeah. So I think definitely more than half. This is a need. And I think the great thing about the polls is just kind of seeing, and everyone's in the same boat, or a lot of people are in the same boat. There's a shortage of just valuable resources, I think, for people to be able to access and get answer to a lot of these questions. That's certainly what Brian and I are here for. The WellCents program really was set up to help you with a lot of these different financial questions that you have. I mean, obviously we're the advisor on your 401k plan, but obviously just from our, own personal experiences working with clients and helping people get information, it's a lot broader conversation than that. And, to be able to put all those pieces together, I think Brian really said it well. It is like a puzzle, and you want to make sure that you're getting a comprehensive look from that 30,000 foot view, but also getting lower and kind of getting into the nitty gritty of how you want to put together a plan and ultimately maintain that plan. and if the plan needs to change, how that's being done. So want to encourage everybody to, to reach out. I know Kelly's sending out our email address to some folks. Feel free to reach out. We'll set up some time, go over some of the specifics to your situation. We haven't gotten to every single question here, but I think we've gotten a lot of them. We appreciate everybody's engagement, and I know we love doing this. So Brian, anything else you want to add as we wrap up here?
Yeah, I mean, we still have 10 more minutes, don't we? Or did we want to try to wrap up?
Yeah, I think we got like a few more minutes if we want to take another question or two. But
yeah, I'm just trying to make sure we I mean, one person, how do internal fees work is there. So again, obviously, anytime you pay a CPA or a mechanic or a financial planner, there's costs obviously of doing business. I mean, that one would be a good, like, that's the question for when you're sitting in front of me, a steward or someone else you're interviewing, right? Like, how do you guys charge? Ultimately, if you came to me, we would do a consultation complimentary, because I got to see if it's even a good fit to work together, both ways, mind you. And then, we can get paid on fee-based, commission-based, or flat, just, flat fees, just like, a billable by a credit card. And we'll structure that typically where it makes the most sense. We will always structure where it makes the most sense for the client. Like, if you came to me and said, Brian, I'm not happy with my car and home insurance, can you guys shop the carriers and take care of that for me? Well, sure. And if we do that and we take over in premium you pay, say Travelers that we move you to, we'll get paid from there. And if that's all that we're doing for you, we don't need to charge you a flat fee. So it depends on the scope of it and the arrangement of the scope and the scope of the arrangement that we put in place. Let's see, what else do we have? Is it better to have money in a Roth so you can withdraw from that to mitigate taxes? So always better to have money in as many buckets as you can. So taxable, tax-free, and pre-tax. So if you just have one or two of the three, you're not as efficient to be able to draw, because we don't know the future of tax rates. So the more you have, the better. Can you tell us some specific annuity products that you're referring clients to? That's a tough one for compliance, right? Right. I can't just, because I got to know like your situation. Yeah, this is from Linda. I'll email you. You can certainly email us, and we got to get your situation. Again, there's thousands of different kinds of annuities with bells and whistles. So it's not just like, hey, buy this
suitability.
One,
Suitability,
buy this one,
right?
This one's good. That's not really a thing. There's just like there's 7,000 mutual funds. One time one guy called me and said, Brian, what's the best of all the mutual funds? I'm like, that's not a question that's not a question, right? Like, that's unanswerable. But yeah, send me an email. Depending on your situation, I can give you some stuff. Stuart, you want to handle some more of these?
Yeah, well, let's take a look at one here. Emerging trends, kind of, again, this gets a little bit like, hey, let me check for my crystal ball here, because we don't know exactly what's going to do well. There's definitely emerging trends. I mean, cannabis was kind of the hot button area. I want to say going back maybe the last 6 or 7 years, as cannabis was really legalized, different states. Sports gambling is kind of the thing now. Crypto is the hot thing, and the NFTs, right? The digitalization. There's a lot of emerging trends that are out there. Those are the ones that are hardest to call. What's going to flame out. They're also typically the most volatile based on legislation that might come on down the pipeline. So, there's not really any specific trend I would say that's not going to be affected by legislation, like the sports gambling side of it. Cannabis obviously was very affected at a state level from a legal perspective. Any other trends? I'm just trying to think of what else we're seeing. I mean, the crypto thing is interesting. I think we're talking to people that are asking, when a crypto is going to be when it's going to be in their 401k plan, like it's a common one that we're getting right now. And, it may never be, right? And until it's something that's going to allow a planned fiduciary to do that in the best interest of their participants, it may never be in the 401k plan. So we're all in the wait and see mode for that one.
Yeah, it's actually interesting. Fidelity, because I know we're getting that a lot. Fidelity, I think, actually did it, or they were about to, and then crypto lost 60%. I think that slowed them down from doing it. But they were the first 401k carrier I knew that was close to getting that done, but I don't think they ever actually were able to get it on their platform yet. Because the issue is the technology, right? Because when you buy crypto, you can't buy it on like E-Trade or Robinhood. Well, actually, you can buy it on Robinhood now, but like you can't buy it on a lot of exchanges. So the exchange that the 401k uses has to physically like contract with like a Coinbase or something to be able to actually buy the crypto. So there's a lot of technological issues that come into play there. Let's see.
We're going through the last poll. We got one more poll question. Let's throw that one up here on the screen here. Market fluctuations. So I think we're seeing a trend here with some of these poll questions, but
This
yeah,
is
when we think about,
yeah. Let me hit this in interest. Yeah, I mean, this is a biggie. I remember I mentioned before when someone comes into my office, the kind of the three main questions I ask them are: how much do you need to retire in a lump sum? How much do you need? How much do you need annually as your expenses in retirement? They don't typically know. And then third, I ask them how much of your total nest egg of savings is, especially your retirement savings and retirement accounts, how much is protected from loss? Meaning not bond funds. We've all seen bond funds can go down. Even individual bonds, they can lose value. How much stuff do you have that can't lose value? If the answer is zero, and most of the time I can tell you, I look and it's usually 0 to 5%, which is not good for someone that's about to retire in a year or two, as we're seeing right now, because then you have nowhere to efficiently grab money versus having to sell something and actually take a loss in a down year like this. So that's something we would, I'm sure Stuart would agree with me, is make sure you're looking at your accounts. And you know what, I don't know. Let me go into my 401k or my IRAs or talk to my advisor and say, hey, what of my money is unable to lose from negative market fluctuation? Plenty of products out there that do this. So there's certain kind of annuities, CDs, structured notes, cash, basically money markets, things like. There's a whole slew of things you can choose in this space.
yeah, no, I think that summarizes it up real well.
What other questions do we have here? Again, thank you. Your engagement's been great, guys. We really appreciate it. And if we haven't gotten to you, we really apologize. Again, this is all about you. So anything we can do to help you, that's we want to try to make sure we can get to as many. I think we've hit most of them. And be honest with you, and a lot of people emailed us like, Brian, can you send us the workbooks? Email our group, email or Stuart or I directly. We can send you all the workbooks and stuff that we use. It's ours helping like project how much income that you need in retirement, but we have a slew of resources, as you can imagine, that we can put in front of you. It's just a matter of, owning the need to want to get that done and put a plan in place.
And take advantage of the one-on-one appointments, I think is something that I would add. So, because you're part of the WellCents program, you have the ability to sit down to meet with advisors, Brian, myself, to go over this. So just keep that in mind. Be on the lookout for those availability time slots when we actually set aside dedicated time with your organization. And then again, feel free to reach out. That's what we're here for. We can set up obviously other appointments around that. So thanks everybody for your time. We appreciate it. We'll see you next quarter, and enjoy the rest of your summer.
Yeah, thank you, everybody. Have a great rest of the week. Enjoy your weekend, and we're here if you need us. Use us as the resource. That's what we're here for. We really appreciate all your time and taking the time out of your busy schedules.